Hey everyone, how you doing today? We've got Joseph Sanchez here from Caliber Home Loans here in Salinas, California. Wanted to get Joseph on Zoom here with us so that we could chat about the lending situation, interest rates. But first, Joseph, why don't you do you go by Joseph or Joe?
I go by Joseph, but thanks for
Joseph.
asking as
Okay,
well.
good, good. Yeah, so Joseph, that way everybody knows. So Joseph, we've known each other for several years, and but I wanted you to just maybe tell everybody a little bit about yourself, and then we'll get into some of the common questions people have right now about loans, interest rates. It's a big topic. It's all over the news, but I really wanted to do this to talk to local lenders like yourself to really get some real information out for consumers that isn't biased. We're not trying to sell people anything here. We just want to get information out to our homeowners, our future buyers, anybody that's just thinking about interest rates. We're not selling commercials here. We're not selling nothing, but I just wanted to really talk with someone like you that's been in the business for several years, and you've been in it a long time. Go ahead and tell us a little bit about yourself if you don't mind.
Well, yeah, sure, as well. So I've been in the business since 1989, jumped in, and this is right when Fort Ord, California was getting ready to close.
That's right. Yeah.
Interest rates at that time were over 16% because I was selling private money at 16% points for 2 to 3 points. And back in the day when I was working, I used to tell a market for a lender out there, and I used to get this question: "What's your interest rate?" I go, "What do you mean?" "We're looking to refinance." I go, "Looking to refinance?" I said, "Well, I'm not looking for that. I'm looking for investors." So anyway, so that's when I knew that my rates were normal to me at 16%, but people were looking for 10% interest rate.
16%. Wow.
Okay, so anyways, I've been in the business since 1989. I've worked for brokers, direct banks, direct lenders, and I happen to work for the fourth largest lender in the nation now. And very proud to have been able to go through these different markets and seasons.
Mm-hmm, mm-hmm. Good, good. No, that's great. And that's interesting you say that, because obviously being with a lender that large, that gives you a national view on things. So I'm sure they're keeping you guys informed, keeping you up to date on what's going on. What are you hearing right now about interest rates? Because that's the most common question I get, right? Like, where are interest rates going to go? What do you think? What's going to happen in the real estate market? We'll get into a few of those, but what are you hearing right now from like your leaders in your industry?
Well, what I'm hearing and what I'm seeing is two different things. What
Hmm.
I'm seeing are rates in the fives and the sixes. But I've been in this business for such a long time as well, where the average interest rate over my career has been 8.5%.
That's a good point.
And so the one way to starve off, let's say, inflation is be a homeowner. And so what's interesting is there's a gentleman that I follow by the name of Barry Habib, MBS
Mhm.
Highway.
What
Yeah,
was the name again?
Barry Habib,
Barry
MBS
Habib.
Highway. And he had did a market forecast. So I'd like to share a market forecast with you. And I totally agree.
Yeah,
Okay.
yeah. Let's do
And
that.
then, just bottom line is when he put this out,
Hmm.
I got to see this now start to move forward. And now it's May 26, 2022. And I agree with this. Okay. And again, I agree with it based off being in the business since
Hmm.
1989, seeing the different cycles.
Hmm.
And so anyway, so what I'm going to do again is I'm going to pivot into my screen. And again,
Okay.
this is not my presentation. This is Barry Habib from MBS Highway. Guy's been around forever. He's personally done about $2 billion worth of loans. I've actually met him in person. Yeah, rock star
Okay.
guy, rock star.
Okay.
Man.
Cool.
And
Cool.
anyway, so
No,
with
that's
further
good.
ado, let's go ahead and let me tee up my slideshow for you.
Yeah. Well, you do that. It's funny because you said interest rates were on average 8%, or I think 16% back in the day. You even said, but I heard someone the other day tell me like having rent is 100% interest.
Oh,
So
absolutely.
I thought
All
that was, I mean, it's funny, not funny, but it's just an interesting take on, do I rent, do I buy, and that's why I really wanted to do this. Is like, I know a lot of people, especially in our area, it's tough, it's tough to find a rental. And then the rents are going up, on average 8 to 10% a year here. They're
right.
just continuing to spike. And even in San Luis Obispo County, we're seeing it's tough for college graduates. Their rents have essentially doubled in the last couple years, whereas their salaries have only increased like 10% in the last 10 years. So it's just tough for students too. But yeah, go ahead and share your screen when you're ready.
Okay. And then before I do that, I just
Yeah.
want to share something before I pivot into the
Sure.
forecast.
Yeah.
I want to throw some content out first, okay? And then one of the things that I'm going to share with you is the real estate report card. And this information is coming from CoreLogic Black Knight. So it's not my information.
Okay.
And I'm
Yeah,
getting
CoreLogic's good. They're a good source.
So I'm getting this from the MBS Highway from the Barry Habib. Anyways, I call this my real estate report card. So before I pivot into my presentation, I do want to talk about what's happening. Okay, so the median price, and this is from San Ardo to Pebble Beach to the tips of Aromas. The median price is 756, 651, more or less.
This is as of April?
As of when I pulled it yesterday.
Oh, yesterday. So this is right to the moment. Okay.
Correct. Now, I do have some of these reports where the numbers were about a year ago, about $100,000 less.
Yeah.
Okay,
yeah. It's about 10%. Yeah.
And again, I can do this real estate report card on any county, pretty much in any state, but we're going to focus on Monterey County.
Okay. Excellent.
Okay. So historical, over a 63-year period, houses appreciated about 5.75. Not going to get that in your bank account.
Yeah. So that's historical, like, oh, that's 63 years. I see where you're at. Okay.
Gotcha. Over a 10-year, 9.23. Mm-hmm. Over a 5-year, 8.39. Now, what was crazy was we never ever anticipated a double digits last year, but over the next year, we're thinking 9.7. Over the next 5 years, we're seeing the median go to 34.25 over the next 5 years. So which means our median may go up to 1,015,802. I hope I'm wrong. I don't know. I just know this. I'm looking at facts here, right?
Right.
Now,
right.
For myself, this is what really grabbed my attention. Do you know we have 438,029 people in Monterey County? We have.
Well, I knew Salinas had 200,000, but I didn't realize the county population was that high.
We have 242,000 renters.
Wow.
We have 61,000 renters right now that can actually afford to buy. Remember, the economy's changed a little bit, right? So now we have different workers. I've never done Zoom until 2 years ago.
Yeah, yeah.
My big claim to fame in Israel was I was local. You got to see me, got to touch me. And then all of a sudden, my world opened with this Zoom. But anyway, so let's get back to how many renters can purchase 61,000. Now, this is where this numbers gets a little fun. If you're 27 to 35 and you've gone to school and you sold your Bitcoin or whatever you have, right? There's 6,000 of them that are ready to buy. Now, in order for us to hit the supply and demand, we need to build 2,692 houses a year. We're building 618 houses a year.
Yeah, and they're all in South County, I think, mostly.
And again, so I'm looking at this. So the reason why that I'm bringing this up, so that way I can, I'm going to stop sharing just for a second.
Yeah, sure.
And I'm going to tee up my next one. Now, this is the one where I really wanted to take you through the forecast.
That's good information just to see the deficit we have in new home construction or just homes coming on the market. You know, I was talking to Chuck Kreider, my broker from Century 21 that had been out for 20 years, and he was telling me they're seeing a lot of their rentals come up for sale. So a lot of our rental market, and we're seeing it across the board, not just there, but I'm hearing that from a lot of property managers that these rentals are converting to actual sales. So that's going to affect renters even more because there's going to be less inventory of homes to rent.
Right.
So I think we're going to see just a continued push on rental prices. So I think that's something to think about. If I'm a renter, it's something to think about, you know, that, okay, this isn't going to ease up on me anytime soon just because the interest rates are rising, you know, so it's creating an even more of an impact, I think, for renters.
Right on. Okay. Anyway, so let's go ahead and let's go through Barry's forecast.
Yeah.
Okay. So anyway, so this is the 2022. So when he rolled this forecast at the beginning of the year, again, now it's May 26th, I'm starting to see some of this stuff come to fruition. And he started calling us out. Okay, so here's the 2021 recap: interest rates. Last year, we expected the rates to rise beginning of the year and recover into the fall. Now, I had some clients out there where they were floating their interest rates, thinking rates were going to drop even lower. So I saw that. So rates right around March jumped up to 3.25.
Yeah.
Everyone thought that the sky was falling, right?
Anyway, yeah, I remember that.
So we kept floating. Right about September, I was able to lock him back in at 2.75, even though he was floating for 2.5.
Yeah.
Crazy. Anyway, so then the housing, the forecast was strong demand, tight supply would push home prices up by single digits. Man, it went up double digits.
Yeah, it caught us all off guard, right?
Right?
Yeah, I don't
Well,
think
now
anybody
check this
expected
one
that.
out. There was strong demand, tight supply, and then COVID caused supply chain disruptions and labor shortages, which again pushed real estate values even higher than our robust forecast.
Mm-hmm.
And I saw that, right? So now here's some dynamics now. The Fed will play major roles in 2022. Do you realize that they're one of the biggest investors in mortgages? So anyway, so they were going to taper the rate hikes, the balance sheet runoffs, which means that they're going to push that mortgages back out to the open market. And that definitely.
I didn't mean to interrupt you, but are you sharing your screen right now, or is this just information?
Oh, I'm sorry. Let me go ahead and
yeah, because just so that everybody else can see it.
I'm not sharing. Just give me a second.
No problem. No problem. I like pictures, so.
Oh, no. So
it's a little easier.
So let me go ahead and let me do this again.
Yeah, I think I made you a co-host, so let me double check.
That's okay.
Yeah, you're set. Yeah, whenever you're ready. But no, that's I think what we saw. I think it's interesting what you're sharing is something that came out in January. You're saying, and now here we are in May. So let's, you always wonder, like, okay, all these guys predicting things and whatnot, like how good are they at it? Sometimes we're kind of always scratch our head about that. Yeah.
And what's crazy is Barry Habib's been calling this out. His team's been calling this out for a while now. Okay, so again, can you see my screen?
Yeah, now I can see it. Now I can see it.
So Feds will play a major role in 2022. We covered that. Now, some of the Fed voting members rotate each year. So 2020 composition will be less accommodating than 2021. Fighting inflation's main focus, negative stock market reaction could cause Fed to lose resolve. Man, I've seen my stock market change a little bit, right?
Yeah, everyone's talking about that. Yeah.
Now, this is what they should have done. They should have hiked sooner. And they kept saying inflation was transitory. Now, one of the things I like history, right? So history can help us forecast how the Fed actions in 2022 will influence the market.
So when they say transitory, what does that mean?
It means that it's temporary.
Okay, gotcha.
It's transitory, it's temporary. Now, let's talk about history. Now, I was born in 65. So over here, this guy over here named Arthur Burns, he was our Fed chair. And back in the day, he ignored inflation, which was rising rapidly. And he insisted inflation was transitory. Sound familiar, right? I'm like, yeah. Year over year, inflation ballooned from 7 in 1978 to 14 by the time he left in 1980. I just remember my parents were having to even odd days for gas.
I remember the gas lines as a kid. Yeah.
Right. And I remember that. But then he said, this inflation was transit. Higher inflation caused mortgage rates to rise from 12 to 18%. Crazy.
Yeah, I see. I remember I didn't understand it as a kid, but I remember people talking about mortgage rates and interest rates at 18%, 16%. So you think about that back then. It's like, for today as a realtor in this market today, like, I can't fathom that, but it could be a reality. And that's that's why I want to talk about all these things. Like, is this what we're looking towards?
Okay, so now 1980. So I got out of high school in 83, so I really didn't care. But I do remember my parents suffering back then, right? Because who's Paul Volcker? He was the next chair. And talking to Ronald Reagan, and man, what do we do? He goes, well, we need to hike these federal fund rates from 11 to 20% in 2 years. Then inflation dropped from 14 back down to 5. Because inflation dropped, mortgage rates dropped sharply. So when I was selling that private money at 18%, 16%, I was having people going, I want to refinance down to 10 to 12. I didn't understand what that meant anyways. Again, there was consequences. The S&P declined by 30%. Tighter monetary policy pushed U.S. into a recession in 1982. I got out of high school in 83.
Yeah, I was 86.
Now, here's Alan Greenspan back in the 90s. So I got to see this as well. 1.7 to 3.5 higher inflation caused mortgage rates to rise from 7 to 8.5. Unlike Burns, Greenspan took action in the mid-1990s and hiked federal rates from 1.7, matching rising inflation from 4 to 7 to 6.5 in a year. Inflation responded, dropped from 3.5 back down to 1. Mortgage rates dropped from 8.5 to 5.5, sparked a huge refinance boom. So the average time some of my clients have kept their mortgages are 3 to 5 years.
Okay.
Pretty much refinanced the world a few times.
Right. Yeah.
Okay. But there was consequences. S&P fell by 50% spring of 2000. U.S. entered into another recession in 2001. Okay, so now here's our new guy, Jerome Powell. And it's good to know who's has this monetary policy.
So these are people that are voted onto that are in control of mortgage rates.
Well, they're not in control of the mortgage rates. They're just setting the market. So they're buying the bonds and things like that, right? So then that actually trickles down to the short term, and then it trickles down to our rates.
Okay, gotcha.
Anyway, so then higher inflation caused mortgage rates to rise from 2.5 to 3.375. So now the Fed, so this is where I'm seeing this stuff happen. Fed is currently tapering their purchase of mortgage bonds and treasuries. Will not hike and reduce purchases at the same time. Well, now they're talking about doing it at the same time. Done tapering in March, likely to begin hiking in May. So now we're hearing about all these hikes. Media's out there pressing hikes out there. But really, what really gets impacted are your short-term money, your credit cards, your car loans.
Okay, right.
Things like that. Anyway, so now the Feds are targeting three rate hikes in 2022, 2 or 3 more in 2023. Inflation interest can still rise until Feds act.
Mm-hmm.
Now here's a big one here. If Feds contain inflation, mortgage rates should drop, but maybe from higher levels. So we're thinking rates are dropping. I'm saying keep buying because there's no inventory out there.
Yeah.
When you're looking at these places, maybe you make some cuts in your budget here and there. But one way to starve off inflation is to get a house, right? So so let's keep going. Now let's talk about, do we see a pattern here? Under Fed chair Burns Volcker, 7, inflation to 14, mortgage rates 12 to 18, Fed funds rates, what they're lending behind the scenes, 11 to 20. Inflation response, mortgage rate response, recession, rates dropped. Again, same thing, 1.7 or 3.5 for Alan Greenspan. Mortgage rates were 7 to 8.5, 8.5. Fed fund rates were 4.7 to 6.5. Inflation response, 3.5 to 1. Now look at rates went from 8.5 back down to 5.5, where we're at today.
Yeah.
Now here's let's go back into Jerome Powell. Inflation 1.75, maybe to 7. Now this is what caught us off guard. Rates from 2.5 to 3.3 when they're in the 5s, 5.25. And we'll talk about solutions, how to starve off those higher interest rates. But for right now, rates are still pretty good.
Yeah. So even at 5, so now this was back in January. This is what they were thinking back in January. Is like, oh, rates are going to go up to 3.4.
But man, it jumped up to 5.
Oh, wow. This is good stuff. Okay, go ahead. I'm sorry.
Now Fed fund rates. Okay, inflation response should drop. Should decline as inflation declines. Stock expensive, economy slowing, recession. So we're starting to see this, right?
Yeah.
We're starting to see this now. Now, here's some of the wild cards. COVID plays a major influence on monetary policy and supply chains. It's because we have smart houses, smart appliances, and we were counting on some of these computer chips out there. What's happening in the world, right? And additional stimulus may fan flames of inflation. There's a lot of stimulus being pushed out there.
A lot of money floating around, yeah.
Cause mortgage rates to rise further, makes Fed's job of controlling inflation more difficult. Runoff on Fed balance sheet. First step, number 1, Fed to stop purchasing newly mortgaged bonds and treasuries. Next step, hike Fed fund rates. Fed is still buying $70 billion a month in mortgage bonds through reinvestments, keeping rates low. If and when Fed stops investments, mortgage rates could move higher than previously thought. Well, they did. Anyway, so here's some of the things on the forecast. We're forecasting a 10% decline, maybe a little bit more. But if you don't need your money in the stock market, what comes up goes down.
Right.
Interest rate forecast. Well, they anticipated a 3.75. Well, it was a little higher than that.
Yeah, I remember that. Everybody in January, December, like, yeah, rates are probably going to go up to about 4. That was kind of like a dirty word back then, even just a few months ago, like 4%. Heresy, And
I'm like, in my 31-year career, I've seen the average of 8. All right, so forecast. We're expecting rates to definitely rise, but decline towards the second half. Strategically, this sets a bias of less upfront fees because of refinance opportunities ahead. So in 2018, when rates went up to about 5%, some of the things that we were doing was we were getting the sellers to do permanent buy downs. Instead of dropping their price, it's more impactful for the client to do a permanent buy down.
Okay.
So just strategy, right? So let's keep going.
Yeah.
Now, forecast. We still think housing will remain strong in 2022, but not as strong as 2021. So I've been in three markets. I've been in a normal market, a seller's market, and a buyer's market.
Mm-hmm.
A normal market is 6 months of inventory. I've seen that, Israel.
Yeah.
Okay, I've been in a buyer's market where it took us 7 months to a year and a half to sell houses.
Yeah.
We were doing open houses and begging people to come in and see these homes.
I know.
A seller's market is 0 to 5 months.
Yeah, that's where we're at now still. Yeah.
Right. And so you got to remember, the builders quit building. That's why there's a lack of inventory. So they're so far behind. And then that other demographic. So again, demand may slightly soften due to rising interest rates, but will still be robust. So my humble opinion, when you start seeing a price reduction, is because it was overpriced.
Right.
That's just my humble. I mean, again, I don't sell real estate. I'm just looking at what I'm seeing. Because again, supply will increase, but will remain tight. Rents, well, here's one where you came in and talked about rents, but rents are going to continue to rise.
Yeah. I think that's a given, even with the new laws. Like landlords are almost forced into raising rents at 10% a year,
sure,
because of the new laws and whatnot. So that's a whole nother discussion, of course. But yeah, no, I like, you actually mentioned something about permanent buy downs. Now that's kind of, well, first of all, the information you just shared is phenomenal, because this was all back in January. So thank you for sharing that. This was back in January when everybody thought, oh, we're going to get to 3-4%. Everyone knew rates were going to go up. We had to pay the piper at some point, but we didn't expect it to really spike this quickly, because by March and April, we saw spikes. And I think the market's reacting right now. I've been watching it on a week by week basis, even the first couple of weeks of May. And you can see sellers are still getting at about 100% of their asking price, 101, 102, as I check throughout the county is kind of the average. All 5 counties on the Central Coast, it's about 102, 103. But it just shows that if I'm a seller right now, I'm getting into the real estate side. I don't mean to take your time, but
that's okay.
If I'm a seller right now, I don't want to overprice my house. I'm not going to be doing the same strategy I did maybe 5 months ago, 3 months ago, even. Right now, you want to price at or below market if you're trying, depending on your timing, of course. So I think that's something that you touched on that's important. But from a buyer standpoint, you talked about permanent buy downs. So, if it's okay, can we get into some of that of like?
Absolutely. So I'll keep it real simple. Okay. So there's what they call a temporary buy down and a permanent buy down. Mm-hmm. So what a temporary buy down is, let's say that we got a market rate of 5.25. We still have to qualify at 5.25, but the first year you would start off at 3.25, 4.25, and then it would cap out at 5.25. While the difference in those payments are going to be escrowed. Okay. So either the seller can pay it, the buyer can pay it. But if my theory happens next year and if these rates drop, that money is refundable. That's in that buy down account.
Oh, okay.
Okay, but we still have to qualify at the start rate.
Okay.
Now, a permanent buy down is where the seller is going to come in and maybe buy down that rate 0.5%, but it's going to cost money. And to where either the customer can come in and buy down discount points. Mm-hmm. And because if my prediction is right, if I was a buyer, I probably would not be wanting to do a permanent buy down. I'd probably be asking the seller maybe for some concession to buy down my rate to help me qualify.
Okay.
Because for myself, if you were to reduce that price by $50,000, $60,000, you're better off giving a concession of 2 or 3%, because that's a lot better than a bigger drop.
Drop in price. Yeah.
Yes, because I saw that in 2018 where I was going, man, no time to panic. Okay, there's no inventory. I'm seeing people dropping prices tremendously. Mm-hmm. I'm like, don't do that. And again, I've seen it where it's overpriced. Of course, you got to price it aggressively.
Yeah.
But it's because again, we're running into buyers out there. If you're a first-time home buyer, you definitely want to, consider meeting with your professional loan officer, but definitely, go through the motions, because these rates as a client, it could impact your buying power. So I've seen things like where I've had clients where they're going, you know what, let's put 10% down. Well, maybe the solution is 5% down and use that money to pay off their debt to qualify. So there's
different
there's
angles you can take. Yeah.
Yes, because you got to remember, where else are they going to get these returns on their investment? Do you realize 85% of homeowners, that's where their wealth is coming from their house.
Yeah.
From their
yeah,
home.
that's true.
So,
no, that's true. Yeah. So if I'm a buyer and I'm looking at all these different options, so it can get confusing. It's overwhelming. Where do I go, right? Like everyone's going to go online first, right? So they're going to hit and we won't need to name names, but they're going to hit all the online sources because that's what gets pushed on you when you just type in what are interest rates, and then boom, all these ads get pushed on you. But okay, so how do I'm a homeowner, maybe looking to refi, or I'm a buyer. What am I guess what I want to ask is, what should I be asking of a lender? Like, how do I pick one? Like, there's so many options, right? Online, there's in person. What should I be asking to help me get through the weeds of all that?
Well, for myself, I'm going to want to know how long you've been in business. I mean, that's a good question, right? Because especially in today's market. Also, number two, are they going to show me more than one mortgage option?
Okay.
Because we need to go deep like that.
Okay.
Number three, are they accessible? How accessible are you? Because if you do go to an online lender, most of the time, you're not talking to your consultant after 5 o'clock. So you definitely
that's a great point, even for a realtor.
You definitely want to have that too, right? Because again, and then also number four, are you the one qualifying me, or are you just taking information to have someone else run the numbers?
So say that again. So
are you the one doing the qualifying, or are you just taking information and having someone else run the numbers?
Okay, so that's kind of like some of the bigger banks, right? Like they're going to just take my info and then it gets sent off
to somebody else. Or it could even be somebody local. I mean, I'm not going to name names. It's just at the end of the day.
Yeah, we don't need that. Yeah.
Where are you going? I mean, where's this loan officer going to be? I mean, is he local? I mean, because I tell everybody this. So there's a couple of ways to meet. You can either meet me in person or online.
Mm-hmm.
And I like both methods because online I can share my screen again. So, and then also number five, I think an important question to ask somebody is, can you please show me the numbers? Because I meet a lot of people out there that have not even been shown any numbers. Show me something.
But I thought there were laws that said you had to show a client numbers.
Well, depending on how deep you go, because if you're doing because remember, there's a couple levels of pre-qualification. So level number one, pre-qualification, I'm just taking basic stuff over the phone.
Okay, gotcha.
That's pre-qual letter.
Yeah.
Second one is, are you running the appropriate programs like the desktop underwriting? Are you analyzing my income? Are you pulling everything? Are you really truly showing me my options?
Okay.
And then the best way I believe is having your loan sent to an underwriter. Remember, I'm not the decision maker. The underwriter's job is to make sure, does it fit the program?
Okay.
So this is where, as a consultant, I'm comparing a couple different options. I want to make sure my client knows, what their strategies are, because I want to have option A, option B, option C. You never know.
So these are questions I can ask. Like, yes. Obviously, this is going to be recorded, so someone can pause these points, and I'll try to highlight those points and put them in the notes when we post the video. But so when someone's looking at these 6 points, are these all questions that a lender should expect up front, or because this is an intimidating thing for a buyer?
Well, for myself, I will give my clients some questions to ask myself, because like, if you're going to meet with me, I'm going to ask you, number one, do you have any questions for me? Because I want to hear what the questions are.
Yeah.
Right?
Yeah.
And so then if they're going to go talk to another lender, I'm going to ask them, and make sure you ask them these few questions.
Good.
Now myself, if I care about somebody, and then also the other thing that I would use, can I interview the last 2 people you closed?
That's a good one. Yeah.
Because I tell everybody this, your experience is either going to be a roller coaster or a kiddie coaster.
That's good.
So during the pandemic, what my job was to keep all the stress off everybody.
Yeah.
And the best way to do that is communication. So again, does your professional, how well do they communicate? And plus, everybody has a different style of communication. I got clients out there, they only want to be communicated by text message.
Yeah. Yeah. That's an important point too, you know, kind of getting back to the communication, because um, so, you know, oftentimes we as consumers, we don't know how the background of lending works. So it sounds like there's lenders that could be salaried, like a 9 to 5 type lender. They're just crunching numbers. And then there's commission lenders maybe that are going to take your call at all hours. Is that kind of what we're looking at? Is kind of there's a great divide there?
I believe that. Now, do I have a life? Absolutely. And so anytime that I am working with my clients, I'm letting them know. I mean, I do share my calendar with my clients. I
Okay.
do let them know this is where I'm going to be at. However, this is who you can talk to. But for the most part, because I'm the pilot, I'm the main communicator.
Yeah. Yeah. So it's okay. So something important to have maybe is your cell phone as the lender,
Absolutely.
because, you know, yes, you work 9 to 5, but maybe I do too. And I need to get a hold of you in the evenings and weekends. So, okay, that's good. So I think these are great questions for anybody to ask, you know, if they're thinking about buying, selling, or refinancing, whatever they're upsizing or downsizing, because it can be intimidating when you're talking to lenders, you know, in terms of, you know, what do I ask? So thank you for that. This is really good information, you know, and then you already gave us your feel kind of, or what Barry Habib had said back in January, where interest rates are going. So what are your overall feelings on rates today? Like, where do you think?
I still think rates are fair. I still think that there's opportunities out there. I also think, though, sitting down and having a professional appointment, going through your numbers, looking at how much money you have to work with, to just structuring the file, because again, rent's going up.
Yeah, yeah,
for sure, and lack of inventory. And I still think that buying a home is probably one of the best things that I ever did personally.
yeah.
I did it for for my family, but also a long-term investment as well.
Yeah, yeah.
And
yeah. So, so there's a lot of options for buyers right now. We talked about buy downs. We're seeing a few. Obviously, some of these rentals are coming on the market, and what I'm noticing is that as they're coming on, they need a lot of work.
Oh man, I'm
And they're
glad you said that
being
one.
sold as is. So, what can I do as a consumer? You know, because maybe I've got an FHA product or a VA product, and a lot of times we have the impression that these things, I can't go buy something that has broken windows or has a half remodeled bathroom, that type of thing. In fact, there was one case in point. There's a property on Granada that just came on the market. It's 1242 Granada Street. It has like a half done bathroom. It's not finished. It needs work. Like it's a true fixer upper. What do I do? Is that something I can look at as a buyer?
Absolutely. I have a solution, and that's called renovation lending. So if you're an FHA buyer, if you're a conventional buyer, and you're a VA buyer, I have the ability to finance those repairs into the mortgage, and I get to take the after improved value. The loan closes, the work starts after it closes. Now, the key to that, there's 3 parts of this loan: the contractor, the client, and the project. If the work is below $30,000 and it's floors and things like that, I can send them to Lowe's or to Home Depot to be able to do something like that. That's called a streamline.
Oh, wow. Okay.
Matter of fact, I'm closing a loan in Salinas where all cash was $799 and needed about $100,000 worth of work to get it in its average condition. And we paid $850,000 for the property, because after everything's put together, they're walking into equity right away, because we're taking the after improved value. Now, the reason why the seller took the offer is because they didn't have to deal with the work. So again,
seller doesn't have to deal with anything. They're just going to get like, it's almost like a regular finance deal, $799. Here you go. So as a buyer, how do I compete with that? Because obviously it's a fixer upper. I'm competing with the cash buyer. So I'm going to tell a client, give them pretty close to their asking or market price for that, because you're looking at the after improved value. Yeah. Okay. Very good.
So again, so for that type of client, that's definitely a conversation, right? To work. I can't recommend contractors, but they definitely got to have contractors. Okay. And it can't be a self-help product, but definitely FHA conventional. and VA do have that renovation component.
Okay, good. And it's almost another discussion in itself, but I wanted to just touch on it because I think just as we were talking, it's kind of something that popped up, like something that we could do.
As a matter of fact, I do want to show them one thing. It's called minimum property standards. So a lot of people don't know what minimum property standards are, correct? So like,
sure. Yeah, go for it.
So I do want to share something with you really quick. Just give me a second. I want to go in here and, okay, minimum property standards.
In fact, you know what? Let's take, I don't know, I don't want to take up too much of your time, but if you did have the time, we could actually use that as a case study. We could just take that property I mentioned. It's not even my listing, but there
it is right there.
All right.
So here's minimum property standards. So anytime that you're, and again, I wanted to know what are the minimum property standards that appraisers are looking at. So because I'm a renovation specialist and I took the classes, they provided me with minimum property standards. So masonry, slab foundation, no evidence of significant cracks that could affect structural soundness. Siding, no damage to soffit, fascia, or siding. Gutters, no missing gutters. Here's the roof, no missing tiles, no holes, no signs of leakage. The roof must be inspected to last for at least two or more years. Here's the driveway, painting, no evidence of peeling chip. Caulking, fencing, grading.
No, this is just for like a standard loan. This is what they're expecting. FHA, conventional.
Even conventional. This is what they're looking at, minimum property standards.
Okay.
And so when my clients are walking, I mean, and then I even had a case where they loved everything, but it needed one more bathroom. So I was able to take a 3-bedroom, 1 bath, and turn it into a 3-bedroom, 2 bath. We took the after improved value, had the contractor, but Israel, the work started after they owned the house.
That's great.
So now so remember when it was all the bank owned days, right? So the only way that my clients could even get into an opportunity was doing these loans. And the only way for us to compete against all cash, we had to be at 10% higher on the offer.
Yeah. I did some VAs like that where surprisingly we were able to get a VA loan done, with that sort of a renovation loan. So it was really fantastic. I was blown away. That's when I first got turned on to all this, and it's a great option.
Great option. So yes, there's options out there. So again, as we're discussing loans, whether it's FHA, VA, conventional, there's solutions. And so again, there's a slew of loans out there. So this is why it's important to be able to work with a lender that has a grasp on most of these loans, and have a team, to where we got specialists. But anyways, that's
okay. Awesome. Oh, that's great stuff. Well, no, I appreciate your time. We've covered a lot on this, and probably more than we anticipated. We said, oh, just a quick 10-minute video. We'll shoot. So I appreciate you taking the time to do it. I think we've gotten some really good information for individuals, whether they're buying, selling, refinancing, or whatnot. I really appreciate your experience and what you've shared to help people. Again, that's the whole purpose of this, is so that we can just inform individuals, get them some information without all the razzle dazzle and the fear mongering headlines that are just selling advertisement. So I just wanted some real information, like what's going on, so this is good. So if people have any questions, we'll put your contact information below. There'll be, they can reach out to you and whatnot as well. And or please like and subscribe on the channel here for more information as well. And so thanks again, Joseph. Really appreciate it.
All right. You have a great day. Thank you.
Take care.